New York City, I'm Julie Hyman, that is Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. We are an hour away from the close on Wall Street, and markets are extending gains, trying to claw back losses from earlier in the week. The move's coming on the heels of a disappointing reading on retail sales. What that means for the Fed's path toward cutting interest rates ahead.
And Alphabet shares under pressure here. It's amid a threat from OpenAI, the artificial intelligence leader, reportedly working on a rival to Google search. On top of that, OpenAI also unveiling a new tool that immediately generates AI video from text prompts. We have all the details on that ahead.
Cool or creepy? Plus, crypto in focus after the close when Coinbase reports earnings. We'll bring you the numbers and analysis. Plus, reaction from ARK Invest Kathy Wood. Coinbase, the top holding in her innovation fund, so you don't want to miss it. All right, let's get you up to speed on the market action here as we see all three major averages near their highs of the session. And once again, holding above this 5,000 level that we have been at for most of the week here, with the exception of the sell-off that we saw on Tuesday. Right now, the Dow gaining almost 320 points. That's good for 0.8%. The S&P up 0.5%. And the Nasdaq up 1/5%. So big tech actually lagging today. It is energy, real estate, and materials, as well as financials, that are helping push markets higher here, even after we got some disappointing data on the retail sales front this morning. And we're sort of in a vacuum in between the biggest of earnings reports. So we should say, as we look at the backdrop, investors' hopes for a soft landing and interest rate cuts further complicated this morning by that falling retail sales number. Mohamed El-Arian, Allianz chief economic advisor and president of Queens College, Cambridge, said those figures were a yellow signal for the most optimistic economic projections. At the same time, he said it's also important to listen to corporate commentary to help decipher where the economy is heading.
Companies are at the forefront, and they have a much better sense of what's going on the ground at turning points. 14 months ago, most people were thinking the U.S. were going to fall into recession. The companies were saying our businesses are strong. So in order of forward-looking, nothing beats what companies tell you.
Unfortunately, my friend, what companies are telling us is not crystal clear, to be sure. We've got sort of a mixed picture in terms of what companies are saying about end market demand, for example.
Yeah, I mean, I think Mohammed is absolutely right. You want to listen to economists and strategists, and we talk to smart ones every day on this show. But to your point, Julie, it is, you want to listen to the men and women who are actually running companies. Yes. What do they say about customers and demand and businesses? It is hard to get a firm read, though, if you're looking for one narrative. We've talked about this on the consumer or China. It can be tough. It depends on the company and the sector. Here's one stat for you I thought was interesting, though. Not just what companies are saying about what's happening now, but of course you always listen very carefully about what's coming. And here's a fact, courtesy of FactSet, saying the percentage of companies, Julie, issuing negative EPS guidance for Q1 so far is 71%, and that is above the 5-year average and the 10-year average, well above both. Now, it is not unusual that you would hear a CEO or CFO kind of sound conservative about the outlook, but what this is telling me, at least so far this earnings season, they're sounding more conservative relative to consensus than even is historically typical.
Yeah, that's very interesting. I mean, there was also the commentary from CEO Chuck Robbins of Cisco, whose numbers disappointed investors. And on the conference call, he said, in terms of the macro environment, we are seeing a greater degree of caution and scrutiny of deals given the high level of uncertainty. As we're hearing this from our customers, it's leading us to be more cautious with our forecasts and expectations. So that was interesting. Part of that has to do with inventory buildup. Cisco, a networking equipment maker, we are hearing more positive comments from other sectors of the economy that perhaps are more consumer-based, for example, in some instances.
Travel's been strong.
Exactly. And obviously on the tech front, we're seeing redeployment to AI from other areas as well, even as overall enterprise spend doesn't seem to have taken a huge step backwards, at least, even if there's some of the caution that like Robbins is indicating.
Yeah, and Cisco, and that's a great statement to pull out because you pay attention to Cisco because they are a tech bellwether, because Chuck Robbins is selling all around the world to a lot of different kinds of companies and customers. So when he points out weakness, people pay attention. It is, you can't blame the CEO or the CFO for sounding cautious here when you think about the seat they're in, and as they look ahead here, just the range of potential challenges that we talk about, rates, inflation, election, geopolitics, it's a lot. And so for them to kind of look ahead and try to make sense of where things are going, not easy in this environment.
No, definitely not. So let's talk to somebody about
Let's do
that tough job with this fresh batch of economic data out today. What's it all mean for the Fed's outlook moving forward? For more, let's bring in Ross Mayfield, Baird investment strategy analyst. Ross, it's good to see you. So, yes, you had CPI earlier in the week hot, then you had retail sales today. How do you put it all together?
Well, the market, as you mentioned, has mostly shrugged off the hotter than expected CPI print. A lot of that is driven by housing, and our view, and I think probably investors' view, is you kind of shrug at housing. What are you supposed to do in the near term? Is the Fed going to really shift back to hawkish and rate hikes over just housing? As far as retail sales, I mean, it's a noisy data print. It's just 1 month after the consumer has really been such a workhorse for 2+ years at this point. So you don't want to write it off completely, but I do think there's potential for some seasonal issues and some weather related stuff. At the same time, the market is going to take any feather in the cap that will make the Fed ease back a little bit and pivot more towards that dovish point of view. So overall, economic data has been good. Every other release this morning on the manufacturing side, on the housing side, was above consensus. The City Economic Surprise Index is still on the rise and has been for months. So I think overall the economy looks pretty good. And if retail sales give the Fed just a little bit of pause, then that's probably a good thing for investors as well.
So Ross, then to your point, if generally speaking the economic data continues to come in pretty good, whether it's GDP or labor market, are you then, Ross, still betting on that soft landing for 2024?
I would be, yes. I think the soft landing is still the base case. I think it's still likely. I mean, inflation is back down to 3%. Core PCE is annualizing over the last 6 months at close to 2%. CPI ex housing is 1.5%. And we just printed 2 of the better quarters of economic growth outside of recession recovery in the last couple of decades. So, I don't know where we declare that the soft landing has happened, but if it hasn't, then it's still in the base case that it's going to happen this year for us. The Federal Reserve might be cutting a few rate cuts out of the picture and pushing them back, but I do think that there's a much higher bar to clear for them to pivot back to rate hikes or a much more restrictive policy stance. They're also talking about what they're going to do about QT over the next couple of months. So I do think all in all, we're looking at the soft landing, and I don't think the Fed has taken that off the table either.
And so, Ross, what about what we were just discussing a little bit more on the micro front than the macro front in terms of companies' forecasts coming in weaker than they have historically, and also some of the commentary we've been getting? Does that give you pause at all?
Maybe the slightest amount. I mean, ultimately, 2023 was about multiple expansion. 2024 needs to be about earnings, kind of backfilling those richer valuations. I do agree with what you all were saying. There's kind of an impetus for companies and analysts alike to be a little more cautious than if things turn out better than expected. Yay for everyone involved, right? There is a lot of uncertainty on the horizon, both in the political and geopolitical sphere. So some of those more global companies that have global end markets and global supply chains might be feeling that pressure a little bit more, especially with the trade environment sure to be a big talking point for the 2024 election cycle. But overall, it doesn't give me a ton of pause. Earnings are coming in better than expected for Q4, as they typically do. The big bellwethers have mostly reported pretty strong results. So it's something to watch, but not something I'm concerned about yet.
And Ross, what are you concerned about? As you look ahead to 2024, any red flags? What worries you the most?
Well, a couple of things. I mean, one, I do think we're at the kind of beginning, early stages of a cyclical bull market. With that said, sentiment is no longer an asset. Seasonality is a headwind. We just seem a little overbought. So I wouldn't be surprised at all by a near-term pullback, call it 5-10% in the next couple of months. You tend to get those around the end of the first quarter in election years. So near term, I think a little bit of a correction is in order, if only to reset things amidst a broader cyclical bull market. For us, managing people's money and being in wealth management, the biggest risks and concerns to me are the things that might cause people to pull out of the market at inopportune times. And so for us, talking through the political environment and making sure that people's money is safe is the primary concern during a presidential election year that's sure to be hotly contested.
So it's interesting, Ross, one of the areas you like is industrials right now, which also sort of feeds or goes along with your theme that the economy is going to proceed okay here. Is that the main reason that you're looking at it? Is there something also to do with where we are in the economic cycle?
Yeah, I think industrials have a lot going for them. So, soft landing adjacent, economically sensitive sector, right? So you've got that going for you if you buy the soft landing thesis. They've been leadership in the market for months and months, behind big tech. They are right there. They are, technically sound, have been leadership for a long time. And then structurally, there's a lot of fiscal spending and kind of secular tailwinds for the sector, aerospace and defense spend as the world becomes a little bit more multipolar. A lot of infrastructure and IRA spending and green infrastructure, goes through these companies. So there's a lot of tailwinds over the next 3 to 5 years, in addition to the idea that if we're at the beginning or the middle parts of a cyclical bull market, those more value and cyclically tilted sectors stand to benefit. So you mentioned the kinds of names that were outperforming today. I think industrials kind of go along with that group, and they've been leadership for a while, so we continue to like them.
Ross, thanks so much for helping us kick off the show today. Really appreciate your time and insight.
Thank you for having me.
All right, let's get to some tickers now. NVIDIA disclosing investments in smaller AI firms, SoundHound AI, ARM Holdings, and Recursion Pharmaceuticals, to name just a few. Shares of these firms getting a boost in today's trade. So this was interesting, Julie. So NVIDIA, obviously, which is kind of the face of this boom of interest in AI we're talking about, we know has stakes now in a few companies. We know, by the way, because NVIDIA included this info in its 13F. So ARM, it looks like that stake was the biggest, about 147 million. Recall, NVIDIA actually tried to acquire ARM, but of course that didn't happen due to regulatory challenges. Then Recursion was next at 76 million. The smallest was about 4 million, it looks like, in this SoundCloud AI.
Yeah, so it's not like they're huge investments necessarily in these companies, but in this current market environment where there's so much enthusiasm around basically anything NVIDIA touches, all of these stocks had big gains today. That includes, by the way, very small companies like micro caps like NanoX Imaging, which is a medical imaging development company, and Too Simple, which is a self-driving company. I mean, both of those are like micro caps. And so it's interesting here. And, both of them seeing gains. Some of these stocks also have high short interest, so you have to take that into account when you look at the reaction here. But it's interesting, this revelation, from ARM, which to your point is a huge company, that NVIDIA tried to acquire two these very tiny companies as well.
By the way, Dan Ives at Wedbush, who we both know, has an outperform on SoundHound. And he liked this news. He said this could be, in his opinion, he told his clients this morning, maybe the start of what he thinks would be a broader investment into that company down the line. Just
one quick point of perspective here on SoundHound, by the way, as we have seen in this, what Peter Bookvar had called a parabola in the stock, right? Right? $13.3 million. Do you know what that number is?
No, give it to me.
It's revenue last quarter. Teensy company. And maybe there's a lot of room for growth, which obviously is what people are betting on, but it is very, very small right now. All right, let us talk about another one that is seeing some big benefit from enthusiasm over AI. It's Supermicro. The shares are up 12% today, getting a boost as Bank of America initiates coverage on the stock with a bullish rating. Bank of America citing expectations of strong revenue growth over the next several years, driven by AI-related demand. This is another parabola chart, right? Maybe this is the one he was talking about. Both of these parabola, these are just huge gains. And, if you look at some of the estimates in this Bank of America initiation, maybe you will see why. They are talking about big numbers in this. They think that they'll be a beneficiary of AI-driven demand growth. That's one of the things they're talking about. They're talking about 50% compound annual growth rate over the next 3 years for the market for AI servers. And they expect Supermicro to be a prime beneficiary of that.
And by the way, viewers were looking at the screen right there. They thought maybe that was a typo. It isn't. This stock is up more than 200% since the start of the year. It is up more than 900% over the past 12 months. But it is not too late to buy this one, according to the team at B of A, Julie.
Yes, exactly. And again, they're putting some of those big numbers behind their estimates for Supermicro.
For sure.
Maybe they're going to have to change the name soon.
It's a great name. It works. It works with that stock chart. Look at that. Another name trending today, Fastly. Let's check out that one. Shares sink in after missing revenue estimates and delivering lackluster guidance. So software company taking a tumble today, Julie. The issue, it looks like, is this Q1 forecast. looks like weaker than what the street wanted to see, right? So they're forecasting 131 to 135 million, and analysts were closer to about 136 million.
And it looks like analysts are pointing to one particular geography, which I guess the company did not specify, a large customer's traffic in a particular geography. Now, Fastly is a software maker. It makes infrastructure software that helps sort of govern internet traffic, if you will. And so, when you're talking about where the traffic is, I guess that's important. They were seeing that lagging effect in that one geography by that one big customer. So hence the big decline in the shares.
Yeah, stocks now in the red so far this year. Should you step in now? Is now a good time, Julie? Most financial analysts who are paid to give you, or at least their clients, that kind of advice say no. They're on the sidelines.
Okay, interesting. Well, we're just getting started here on Yahoo Finance Live. Coming up, another full slate of earnings reports on tap after the bell today. We'll give you the latest from Coinbase, DoorDash, DraftKings, and Roku. And at 4:30, I'll be talking with ARK Invest CEO Kathy Wood to discuss those numbers from Coinbase, as well as her stake in the platform and much more. Stay tuned. All your markets coverage still to come on Yahoo Finance. Stellantis shares popping as the automaker reports earnings and announces a new buyback plan despite warning of a turbulent year ahead. Senior autos reporter Prasad Subramani was on that call, so a little bit of mixed messaging there maybe.
Yeah, so strong earnings are in full year 2023, so good revenue, good profit outlook here, but they're kind of warning about this turbulent year ahead. A couple of headwinds they're talking about is EV product mix, of course, the kind of shifting prices and demand and the offerings they have in the dealerships. Talking about, of course, higher labor costs because of the strike, and then of course price normalization, lower prices coming in. So these are the kinds of things that they're concerned about. But they think that at least in America, compared to the other big three, they have better pricing power and they can kind of wade through that. On the call, CEO Carlos Tavares was on there. This guy's kind of known as I wouldn't say a maverick, but he's very opinionated. And he talks about how we weren't ready for the EV transition years ago, and now he's sort of having this kind of moment to roost here. But he does say that in 2025, in North America, they'll be profitable with EVs. He does think that a shared platform, which they did as opposed to GM, where they said this one platform can use for gas and ICE cars, and EVs. And also he said that margin parity is needed for EVs and ICE vehicles in order for them to compete against, quote, the Chinese offensive. So,
how close are we to that?
I mean, he thinks that in 2025 you start climbing towards that. Probably not till mid to late decade, I would say. Yeah, for sure.
So we heard from Stellantis, Praz, today, but also Ford's Jim Farley.
Yeah.
I thought he had a lot of interesting to say. Like, he talked about China too and kind of the ramping competition there, but also was just kind of open to working with others.
Yeah, he sort of been rumblings of this for a while now. He kind of hinted at sort of how they can make cars and batteries cheaper in the earnings call, and today he sort of indicated that he could work with potentially Chinese partners to do that from a battery point of view. Adam Jonas has been talking about this for a while now, or in his last note, hinting that that could be a possibility. They have a JV operation in China that they could leverage there. But also, just like Tavares, warning about China, warning about how he needs to have a really cost-competitive, cheaper EV platform to make these cars that people need at a price that'll work for them. And also today, this is new to me, he mentioned that 20 to 30% of revenue is at risk due to Chinese car automakers coming to the U.S. Right now, there's almost a 30% tariff on Chinese-made vehicles, so they're probably happy about that, but we'll see if that sticks around.
Wow.
All right, Praz, thank you. Appreciate that. For more on what is happening in the EV space, joining us now is Itai McKelly, Citi U.S. Autos and Auto Parts Analyst. Itai, it is good to see you, and I wanted to get to a note, Itai, you recently wrote here. You're now trimming your estimates for EV sales, both for this year and next, Itai. Itai, why did you make that call there? What are you seeing in the market?
Well, thank you for having me. Yeah, we did trim our estimates recently by a modest amount. We still see EV sales actually reaching about 9.5% penetration in 2024, and close to 15% by 2025. That said, given the slowdown and some of the revised plans by the automakers that we've seen announced, plus I would say a tough start to January. Although December we think was actually a very good month, but just given the slower start in January, we did trim our numbers a little bit. I would say our views are probably still above the current consensus thinking, which has been very bearish on EVs the last few months. We don't completely agree with that. There are some adoption challenges out there that's reflected into our numbers, but we still think we'll have a pretty good year for EV growth this year on the back of some new product.
And who do you think is going to be the big winner in EVs? And is that going to then determine who's the big winner overall in sales this year?
Yes, I mean, overall, EVs are still a small part of the market, but at close to 10%, we think this year. We do believe, of course, Tesla will remain by far the market leader. Our forecast for market share this year is just under 50%. We think a new product, including the refresh on the Model 3, is going to be key for them this year. Of course, Cybertruck ramping as well. And then General Motors, as they ramp their Ultium platform, we think could be in about 11% market share. So sort of the first non-Tesla automaker with a double-digit market share this year as they ramp that platform. We think we need more product in the EV market. If you look at just some of the market coverage to date, it's pretty uneven in certain segments and certainly in certain price points. And one thing to keep in mind in the whole EV debate that's very important is in the U.S. we have on average about 2 vehicles per household. So the burden of EV adoption isn't about changing one's entire lifestyle to go all in on EV initially. It's really about converting households largely to one, combustion or ICE, and maybe a second one with EV. And if that starts to happen, you could see, in theory, a pretty rapid uptake of EV adoption over the next few years. But you need additional product. Of course, you do need better EV charging infrastructure, lower pricing, which IRA should help to some extent this year as well. So we think structurally the market is probably in better shape than what consensus currently bakes in.
And Itai, you mentioned pricing. Is that, in your opinion, is that the biggest challenge for adoption right now? I ask because if you were in the market, you're looking for an EV, let's say around $35,000, Itai. There aren't that many options. Do you see that changing, though?
It certainly is part of it, and in survey work that we've done, it does come up as one of the top 3 reasons and pain points of EV adoption today. But EV charging infrastructure, range anxiety, even product availability also comes up in some of the survey work that we've seen. And what's interesting is some of the lowest priced EVs in the last couple of years have not been the most successful from a volume perspective. And one of the really impressive things that Tesla's accomplished amongst many in the last few years is, when you look at some of the third-party data around conquest, who are they actually taking share from? There's a fair amount, more than I think people might commonly believe, of that conquest coming from mass market brands. As you actually see, and that's one of the appeal of EVs, right? With successful EVs have done some pretty incredible things in terms of market expansion and conquesting from segments that are even lower price. But broadly, to your point, yes, price has to come down over time to increase adoption. That we think 9.5% this year can still be done with some modest degree of a price premium relative to the overall market.
Itai, I guess I would ask my earlier question a little bit differently in terms of the number of vehicles versus the number of vehicles. If I am an investor and I am betting on the long-term viability and growth and eventually maybe dominance of EVs, is Tesla the way to go, or do I actually want to bet on one of the more traditional automakers who maybe have more room to expand there?
Yeah, everything is individual kind of risk reward. Right now with Tesla, we are on the sidelines with a 224 target. Looking for more convincing entry points there, just on valuation. I think you want to look for opportunities where EVs can be very additive and accretive to market share and, of course, longer-term profitability by much more than what consensus bakes in. In GM's case, for example, right, and even Ford's, where you have substantial losses, we believe, running through the P&L today. If you can protect key parts of the combustion business, for example, pickup trucks, which we think will see slower EV uptake, then the EV uptake more broadly could end up being actually accretive to the overall earnings over the next couple of years if these companies can execute. And those could be really interesting risk-reward opportunities because you can see some real healthy degree of potential upward earnings revisions as those things play out. So we look for a combination of defensive qualities in companies and, of course, offensive qualities with EV, where you can have a real path to earnings upside and accretion. Of course, Tesla is still by far the market leader. Again, we think about 50% market share this year, and will still be by far the leading share in 2025 by our estimates as well, about 40% share roughly. But right now we are neutral on it, just on valuation and kind of the latest risk-reward assessment.
Yeah, for sure. It's going to be an interesting year in the next couple of years to see how all of that shakes out. Itai, thank you so much. Appreciate it.
Thank you.
Bitcoin is pulling back from the 52,000 level, and the popularity of so-called digital gold is widening its lead over physical gold. Jared Blickery is here with a closer look. Hey, Jared.
Hey there, Julie. Let's take a look at Bitcoin flows on their own, and then we'll get into the gold. Interesting to look back to the very beginning of the pandemic, January of 2020. We saw this huge spike. This spike here coincided with the ultimate highs, roughly speaking, in Bitcoin and a lot of other tokens, also Ethereum. And then we dropped off a cliff. And then what's interesting to me is this was the year of bankruptcies, and they're in the year of 2022. But you see the flows somewhat stabilizing. Arguably, the weak hands were already chased out. But now, importantly, we are on the rise again, and Bitcoin exceeds its prior highs. I wouldn't be surprised to see those flows highs taken out as well. And Julie, you mentioned gold. We have two different markets here, two different axes, but I want you to take a look at the shape here. We have Bitcoin flows, and this is all of Bitcoin. This goes back to a year earlier, January of 2019, and then gold. So Bitcoin was relatively flat throughout this entire time. Now it is picking up. There's slightly different way of measuring. And then the gold funds, you've just seen this steady drop. Is either one of them actually a great inflation hedge? That's not up for me to decide here, but just wanted to close on the price here. Bitcoin looking really strong. Not this chart, but when we take a look at the heat map, there we go, 52,000 and change, 51,777. I think investors will take that.
Jared, thank you so much. Appreciate it. Later in the hour, Brian Sazi will sit down with executives from Restaurant Brand International, discuss their latest quarterly earnings. Stay tuned. All your markets coverage still to come.
It is about the culture, and it is about making sure people feel like they belong and that there's a path for them.
It's the promise that I will keep you relevant, I'll keep you growing.
You want to keep your best people. I don't think that changes over time.
For the first time in modern history, there are 5 generations in the workforce. We've got Gen Z, millennials, Gen X, baby boomers, and what some call the silent generation or traditionalists. There's a lot of different constituencies to manage in terms of that. Stephen, I know you work in your work with leadership and with folks working through business schools. And so how are those priorities for people who are just entering the workforce different?
Yeah, so at Exec Online, we sort of work with everything from, sort of frontline or aspiring managers up through the C-suite of the organization. So we see some of these generational differences, and I think they're pretty significant. And so the question is, how do you engage that constituency differently than maybe someone who has changed jobs 3 or 4 times over the course of their career? Bridging that divide is really about making sure that organizations have very clear, sort of expectations around how we lead in line with our company culture. And you see organizations facing those challenges quite a bit today.
Lindsay, given that, if you know that you manage a certain number of workers and, some of them might not be there for very long, do you think about how you develop them, how you relate to them differently than you do with older workers? Or do you have to sort of be agnostic?
It's really about how you are training, how you are taking care of your people, and thinking about them long term, whether that long term means that they are in your organization or depart. It is about the culture, and it is about making sure people feel like they belong and that there's a path for them.
I think what we're seeing is this pivot in what is the core of the value proposition from what might have been, traditional pay and benefits to increasingly this promise of continued relevance. I've got an airline client that actually changed their value proposition in airline. Just wrap your heads around that for a second. To say, no longer will you be here, for the promise of flight benefits and that your grandparents had, but we will develop you for opportunity, either within or without. It's the promise that I will keep you relevant, I'll keep you growing. And, there may be opportunities here, but perhaps at some point there may not be an opportunity here.
You want to keep your best people. I don't think that changes over time, whether you keep them in one, sort of cycle or whether they come back to the organization. And I think learning is a critical component. We measure effectiveness in 3 ways. Are you improving retention? Are you improving worker productivity? And are you helping them better achieve their organizational goals? And what is striking is that what we find is when you make those right investments, over 60% of our leaders say that they would work 10% harder, right, in order to deliver against organizational prerogatives because of the investment that's been made in them.
There's something else I want to ask you about this multi-generational workforce, and that's stereotypes. Like, you guys have probably seen TikToks or Instagram Reels or whatever, where it shows the different generations in the Zoom meeting and how the different ones are acting or whatever it may be. Do you just recognize that those exist? How do you deal with those? Lindsay, I'll start. You look perturbed at that.
No, I think ageism is actually an insidious form of discrimination in the workplace, and it disproportionately affects women and people of color in the workplace. And so it's something that we need to be aware of. We don't talk about ageism when we talk about diversity. We often don't think about the fact that men view women who are young mothers as less dedicated to their roles than fathers. So there are these kind of levels of stereotypes that are very much tied to age, to generational bias that I think social media certainly fans the flames of, and we all can kind of relate to. But so much of that is really negative and, again, disproportionately affects women and people of intersectional identities.
So do you talk about it? Do you bring it out in the open and you make it transparent? Is that the way to deal with it?
Yes, you have to talk about ageism. You have to be comfortable making sure that that's a part of your DEI strategy.
I think a lot of these distinctions around, well, older employees do this, younger employees do that, there are going to be some older employees that are going to embrace generative AI and say like, wow, this is really exciting, let me dive in. And there are going to be some younger employees who say, oh, this feels like a threat. And so I think we should talk more in those terms, because I think we get to better outcomes than trying to create these distinctions.
So many organizations have this legacy. We talked about control earlier, this one-size-fits-all proposition, right? You come here and you be a membership of my organization, but you have to fit. You know, you have to sort of, everything I'm giving you is what everyone gets. And more organizations, Julie, moving to say, we're going to meet more people on their terms. We're just going to have a much more inclusive set of propositions, more choice, so that we can meet you on your terms as opposed to forcing you to meet us on ours.
Mortgage rates ticked up this week to the highest level in 2 months. That's according to the latest data out from Freddie Mac. With more on what's driving rates higher, here's Yahoo Finance's Rebecca Chen. Rebecca.
Hi, Josh. Thanks for having me. So we actually been tracking 2 separate indexes, and they both show the same picture. And it is that the average 30-year mortgage rate has been going up. On a weekly basis, rates went up about 13 basis points to 6.77%, and this is according to Freddie Mac. But what is really interesting is on a daily basis, we actually saw a lot more fluctuation with mortgage rates. Earlier this week, rates actually went up to 7.13%. Way past the 7% mark, and then eventually it did come down to the high 6%. And the reason why this is happening is really because of strong economic data. The CPI numbers that we've seen earlier this week show that inflation are still higher than expected, and it is not down to the Fed's target rate yet. And the mortgage market is really just reacting to this.
And so, speaking of reacting to this, as we see the mortgage rates climbing, what are we seeing from people who are looking to buy, especially heading into what tends to be the busy season, spring and summer?
You know, what we're seeing is, unfortunately, it's still quite a grim situation for a lot of home buyers who actually step to the sideline waiting for rates to drop so they can come back with a little bit more home affordability. But that hasn't happened yet. And a lot of people are actually still waiting. We actually saw another set of numbers that show the mortgage application activity dropped another 2% this week. So again, we are seeing that home buyers are rate sensitive, and they have been reacting to the ups and downs of the rates. And a lot of the experts has been predicting that there's going to be a rate drop later this year. And a lot of experts originally thought this was going to happen by the spring season. So now we're really just waiting and see what's going to happen. And home buyers are definitely waiting for that rate drop to come so they can all come back to the market.
Yes, a lot of people waiting for that. Rebecca, thank you so much. Appreciate it. Still to come, shares of Google's parent company Alphabet down today after reports that OpenAI is reportedly planning to launch its own web search tool. We've got the latest on that on the other side of the break.
All right, welcome back to Yahoo Finance. Busy day down at the New York Stock Exchange for Restaurant Brands. Of course, that is the company owns Burger King and many other chains. And I should have mentioned Tim Hortons as well. Let's bring in the two stars of the hour down here. That's Executive Chairman Patrick Doyle and Josh Kobza, the CEO of Restaurant Brands. Good to see you both. Pretty packed house, turnout, right, upstairs here. What did investors want to hear from you, Patrick?
They want to hear about our future plans. So what we laid out today was our long-term growth algorithm for the business, what we think we can achieve across the 4 brands, our 5 business segments, and hopefully they're excited about it.
Do you think they're excited about it?
I think people are pretty excited about the outlook. We just announced our earnings a couple days ago, and I think we've made tremendous progress on sales, and perhaps most importantly on franchisee profitability. Across all of our home markets, our franchisee profitability was up over 30% in the last year, and I think that's the underpinning of our future growth. If our franchisees are doing well, we're operating our brands well, we're going to grow all around the world, and that's what has us and our investors excited.
Patrick, how does this dynamic work? Executive Chairman, CEO, you passed your 1 year mark. So how does this work? Like, is it coaching? I mean, how do you work in close concert?
All the work.
He does all the work.
I just lob
that sounds
in
like
ideas.
Executive Chairman.
I just lob in ideas. He does all the hard work.
Does all the hard work. One thing that stood out to me, reported earnings earlier this week, Josh, there seems to be a turnaround happening in Burger King US. Now, I know this has been a long undertaking to get down to this path, but why do you think the brand is in fact starting to turn?
Yeah, so I think Tom Curtis, who runs the Burger King business in the US and Canada, and the rest of his team have done an incredible job. They put in place the Reclaim the Flame plan just about 18 months ago, and we're making big investments in the brand, in the infrastructure, alongside our franchisees. Those investments are really starting to show results. We saw big improvements in sales. We had our first quarter of positive traffic. We saw operations improve, and our franchisees' profits were actually up about 50% year on year. So all those things are sort of moving in the right direction and reinforcing each other. Tom calls it progress, not success. I think we have a long and bright future for Burger King, and we're going to keep at it.
What is the driver between that franchisee profitability? Now, I talked to a lot of folks ahead of this interview on the street, and they all pointed out higher profits for those franchisees. It took a lot of folks by surprise. Can you point to, is it better menu items? Is it better operations, or have costs just come down?
Yeah, I think the biggest driver is the sales growth. That makes everything easier in our business. And the good news is our sales were up really healthy levels over the past year. That's what's allowed us to drive improved profits alongside some moderating costs. The great news about that is that that's what allows our franchisees to reinvest in the business. It allows them to staff the businesses better. It allows us to upgrade technology and equipment, and ultimately to remodel and improve our assets. Those are the things that kind of kick the flywheel in the right direction and allow us to keep improving the business.
A lot of focus, Patrick, made a big bet on Carroll's in the process of acquiring that business. We'll get to have a lot more restaurants in the chain. What will that let you do in terms of bringing the business to the next level?
Yeah, there are really a couple reasons why we did it, and so ultimately, Carroll's a very good operator of Burger Kings. They also own some Popeyes as well. They're very good operators. They've got great people in there who know how to run the restaurants. So what we're doing is we're going to buy Carroll's. It's still a pending acquisition. We are going to re-image all those stores. So 600 out of the 1,000, we're going to remodel, make them look great. And then we're going to give opportunities to the people within Carroll's who are strong operators to become franchisees. Some of them we may sell to some existing franchisees. But the idea is we'll have great looking restaurants. We'll accelerate the progress there, and then we'll split them up into a lot of local owner operators who we think are going to do an even better job of running them over the long term.
Our first conversation, Patrick, was in 2014. I was at a different publication. You were the CEO of Domino's, but you turned around Domino's. Can you point to some similarities with Restaurant Brands? Where is this company in its turnaround?
I didn't turn around Domino's. A lot of people there did amazing work, including Russell, who's still running it. But the basics work in this business. I mean, it's what gives me confidence. If you're making great food consistently, if you're giving people good value, if you're giving them fast, friendly service, the restaurants look great, you're going to be successful. Everybody knows that. The issue is, do you do it? Do you actually wake up in the morning and say, that is the minimum that is acceptable for us in our brands? And when you do that consistently, you're actually going to be better than most out there, and that's going to generate growth.
And I should know it. You put your money where your mouth is. We talked about it. You have $30 million in what, 5 years? Over 5 years. Are you putting more money in? Are you that remain a big believer in the brand?
No, so I locked up, so I cannot sell anything for 5 years. I am all in. I look at it as a terrific opportunity from an investment standpoint, but also I'm excited to help Josh and the whole team to kind of figure out how do you do this? What are the places that maybe digital can be brought to bear to accelerate the growth, to generate better profits for the franchisees? I'm very excited about the progress we're making, and even more excited about what we can do, over the course of the next 5 years.
Josh, I'll tell you this, I'm still remain obsessed with reading earnings calls. Now, one of your competitors, Wendy's, came out this morning and said, we're investing $50 million more into breakfast. And maybe that's going to lead to more discounting in the breakfast category. How do you respond? Because that's a lot of money by a key competitor.
Yeah, so what I think we need to be focused on is really our core business, and that's what you've seen us doing. Whether that was at Tim Hortons, focusing on improving the quality of our core and investing to tell people about that in Canada a few years ago, or what we're doing now with Burger King. We're focusing on our core equities. Flame grilling, the Whopper, have it your way. We're putting all of our money behind the core. I think that's the best way and the strongest way to take these businesses forward. And so that's where we're going to put our investment, and I think that's what's paying dividends so far.
Real quickly, favorite item on the menu?
Probably the Popeyes chicken sandwich from Popeyes. Burger King has to be a Whopper. I love the Tim Hortons cold brew, and Firehouse, a hook and ladder.
Don't tell me Whopper.
Whopper.
All right.
Cheese.
Fair enough. All right.
Spicy chicken sandwich at Popeyes, although the new wings are amazing.
All right, you still got it, Patrick. All right, Patrick Doyle, always good to see you. Josh Cobbs, good to see you in person. All right, Julie, Josh, back to you. Hope you're hungry.
I don't know what my favorites would be at those places. Thanks so much. Appreciate it, Saz. OpenAI reportedly developing a web search product that could rival Google, according to a report by The Information. Yahoo Finance's Dan Halley here with the details of what we know and whether it's really going to be a competitor.
Yeah, I mean, it's an interesting story, right? This is essentially the flip side of what Microsoft tried doing, right? They took Bing, they integrated OpenAI's GPT technology into it, as well as their own AI, and they said, we're going to steal market share from Google. And it's been a year, and it hasn't really happened. So now they're just kind of reversing it, I guess, and having OpenAI work on some kind of search product that would be powered by Bing technology. So it's weird. There's a reason why Google is where it is, because they are the best search engine, right? I mean, they have been for a very long time. Don't tell Yahoo that. But the idea that Microsoft is going to be able to overcome that 90-something, I think it's like 97% desktop rate of market share, I mean, it's tough. It's going to have to be something radical to do that. And according to that article, they were saying that ChatGPT has continued to grow the website's user numbers. Bing has stayed relatively the same. So, I mean, maybe it is a better idea to go with ChatGPT. Maybe it's the name and it's going to get people into it more. It's a good idea, but for me, frankly, I use the Edge browser, Microsoft's Edge browser, rather than Google's Chrome. But I use Google Search rather than Bing because the search results just aren't as good. I mean, if I'm looking for something, Google's going to pull it up. Bing just isn't.
Yeah. Switching gears here, Dan, to another tech giant. Microsoft out with some updates on its Xbox business.
Yeah.
Yes. What's the updates there? What's the story?
So this has been something that's been kind of bubbling around in gaming, where there was a discussion that Microsoft was going to bring first-party titles to rival consoles, and they are. And there's a reason why this is a big deal, because you have a first-party title, which means the company that makes the console also makes the game. Those are basically the inroad to buying console. You wait until a company releases a good first-party game, and then you say, now I'm going to go buy that Xbox, or now I'm going to go buy that PlayStation. Sony's great at that. Nintendo, I mean, amazing at that. It's sold 136 million Switch consoles. And Microsoft isn't so good at that. So what they're doing is they say they're going to bring 4 games. They did not announce them specifically. They want to let the studios who develop those games do that on their own, to the PlayStation and the Switch. The important thing to note here is, though, that Xbox chief Phil Spencer said it isn't a fundamental change in their exclusives strategy. So they're still going to have those. But they're also now looking at the idea of bringing some of those to other consoles as well. The reason why that makes sense for Microsoft is because you're getting more people into those games. Ultimately, what this all comes down to is Microsoft's Game Pass. It's their subscription service. They have 34 million subscribers they just announced. That's $9.99 a month, $16.99 a month for the Ultimate version. I subscribe. And if you get people hooked through the PlayStation or through the Switch, it doesn't matter if they don't have the console. They can get on it on PC. You can do it through your Mac, right? A Chromebook you can do it through. And that's the ultimate goal, is Game Pass being the big subscription service that pulls people in. And look, 34 million gamers a month, that's not bad.
Yeah, not bad. Quick question, number one game in the Halley household right now?
Right now, it's Like a Dragon, Infinite Wealth, and it's going to be Persona 3. And then Tekken 8. My wife is so good at Tekken. We played it in an arcade. I kicked the arcade and I got kicked out. So
yeah, well,
I don't know what any of these things mean, but it sounds fun.
It's frustrating. Dan Halley, thank you. We move on. Take a look at shares of Wells Fargo today. Stock is soaring. This company moves one step away from its fake account scandal. The company saying one of its main regulators lifting a key penalty from that scandal. The Office of the Comptroller of the Currency saying the bank has made sufficient progress revamping its systems that guard against customer harm. So the history here quickly, Julie, this one is, Wells Fargo's compliance issues, came under scrutiny. There was a scandal, sales practices a few years ago. Anyway, regulators stepped in. Reuters pointing out the bank actually still has 8 open consent orders, right? It is still operating under this asset cap imposed by the Fed. I thought it was interesting here, though, a note from RBC's Gerard Cassidy, who we know, smart, longtime analyst, and he said the lifting of this consent order, he told his clients, in his opinion, paves the way for the Federal Reserve to now lift its consent order. That's his
Interesting.
take.
Yeah, I mean, and there are 6 that under Charlie Sharp's leadership, I believe, have been taken off since 2019. So these are just a number of overhangs that have been very persistent for Wells Fargo.
Yeah, Sharp saying here in his statement, I've repeatedly said that implementing a risk and control framework appropriate for a bank of our size and complexity is our top priority. And closing consent orders is an important sign of our progress, and investors clearly like that headline too. Yeah. Coming up at 4:30, ARK Invest CEO Kathy Wood joins the show to discuss the latest from Coinbase, her stake in the platform, and much more. Stay tuned. Closing bell on Wall Street is coming up.
Here's the closing bell on Wall Street. So let's do a quick check of the markets here as we close things out. We've got all three major averages in the green here. The Dow up by almost 1% here, almost 350 points. The S&P climbing by more than 0.5%, well above 5,000, and the Nasdaq gaining 1/3% here. Good for a gain of about 47 points as we have strength here today in energy stocks and financials and real estate. Some of the groups that we have seen show strength. Tech stocks have not been as strong today, but Jared Blicker's got more information for us as stocks close near the highs of the day. Take it away, Jared.
Not only that, Julie, I was just checking in on the small caps, Russell 2000, and over the last 3 days, and let me just put a 4-day chart here, we are up 2.5%, and we have clawed back the losses that we had a couple days ago off that nasty CPI print. So here we are, right back up to where we were before, and the S&P 500, pretty similar story here. Let me get the 4-day totals for you, and you can see just barely positive, but 5,029, that's going to be good for a record closing high. So take that to the bank, and let's check out the sector action where we have energy. That's in the forefront. Crude oil, WTI up over 2%. Energy following on its heels. Then we have real estate. That's been one of the leaders most of the day, maybe an interest rate play, followed by materials, financials, utilities, and consumer discretionary. Everything on the top line up more than 1%. So some impressive gains there. And let's take a look at the leaders. We got oil, that's a small oil ETF up 4%, followed by cannabis, regional banks. Remember them? They were taking a drubbing just a few days ago, but you take a look at the 5-day chart, clawed back all and more of a lot of those losses. Let me check on the 10-day there as well. There you go. That's more the choppy action that I remember. Then small caps. We were just covering the Russell 2000. Those are leading today, and then disruption as well. We've seen disruption take some interesting twists and turns. Coinbase has been on fire recently, up significantly over the last few days, 28% over the last 2 days. That's as we see Bitcoin above 51, 52,000, Shopify up 4%, Roku up 3.5%. One thing that has been floundering lately that's doing well today is China, and we can see a lot of these issues, including Pinduoduo up over 2%, Li Auto up 1.5%. And let us take a look on the EV sector. We see Tesla up 6%, Ford up 2%, GM 1.5%. So some pretty broad-based gains, although as you mentioned, Julie, tech not quite as good today, not quite as strong.
All right, thank you, Jared. Investors' hopes for soft landing and interest rate cuts further complicated this morning by retail sales steeper than anticipated decline in January. Major indices regaining ground after Tuesday's sharp sell-off, with the S&P 500 notching a new high at today's close. We're joined now by Rob Konzo, the Wealth Alliance CEO. Rob, it is good to have you on the show. Just help us make sense of this market, Rob. You know, Tuesday, of course, we had the big sell-off, lots of worries about what that hotter than expected CPI print was going to mean for the Fed, but listen, investors then stepped in. They bought that dip. What do you make, Rob, of just kind of where the market is now and where you think we're headed?
Yeah, well, thanks for having us on the show. Yeah, Tuesday was eye-opening. People started saying, oh, well, the game is over. The trend's going down. Not good where it should be. And then retail sales came out. And you get a mixed bag of indices. And I think the market's reaction over the past couple of days has been the right one. It got nervous, it came back, it shrugged it off. And one of the reasons why the market, I think, is doing that was this is not the first time we've seen economic data points be choppy. From July, August, September, data points went in the wrong direction, market tanked, they turned around. November and December came back big. I think that set us up to start to think about these data points in a little greater context and say, okay, the longer term trend is right. The Fed's staying on their course. Jerome Powell is saying we're keeping at it, staying on the course. So I think the market is doing what it should do, taking these data points in context.
And so I guess what is the context then for the retail sales report, right? Is it just a matter that we need more evidence to see if indeed consumer demand is slowing?
Yeah, I think retail sales right now, it's a seasonality type index coming January. CPI as well as retail sales are very seasonal, number one. Number two, retail sales is a very goods-oriented index. Many people right now are spending money on entertainment, feel-good experiences, and retail sales doesn't really bring that into context too well. So when you start to think about retail sales and it faltering a bit, I think when you start to look at some of the things that go against it, it doesn't hold as much impact as one would think it should.
And Rob, I'm interested to get your take on valuation. How does it look to you after the kind of rally we've seen here?
Well, I think the valuations, I mean, depending on the sector you're looking at, the tech sector, PE is 46. That leads me to wonder, hey, why did the tech sector drop and all other sectors did well? I think one of the reasons you could point to is you look at a NASDAQ, 60% tech weighted roughly in 1 year is up 31%. Large cap growth up 9% on the Russell. So it pulling back a bit isn't the worst thing in the world. And when you have very expensive stocks within the sector, any little news shakes investors, they take profits and wait to see what's going on. I think we could all agree, retail sales, CPI, and other indices, we need to see continued trend over longer periods of time. And that's what I think the Fed and Jerome Powell, he said he's doing, and I think he is doing that, and I agree with it.
Rob Conso, thank you so much. Appreciate it. Got to move on to some breaking earnings news right now. So let's do that. Shares of DoorDash, they've been bouncing around actually after the company reported its fourth quarter numbers here. And that's because you kind of look, there's a lot of numbers to sift through, first of all. So let's get to them. The fourth quarter adjusted EBITDA coming in at $363 million. That's ahead of the $356.2 million average analyst estimate. Revenue coming in a little bit ahead of estimates as well, $2.3 billion, $2.24 billion is what analysts had been estimating. There's some forecasts here too coming from the company. First quarter adjusted EBITDA, $320 to $380 million. $360 million is what analysts had been predicting. And for the full year, DoorDash says gross order value will be $74 billion to $78 billion. Analysts looking for $76.5 billion. So overall, it looks like the numbers pretty much coming in line with to slightly better than estimates. You see the shares, again, kind of bouncing around. At one point, I saw them up. And then they were down a little more than 1%. Now they're down more than 4%.
Yeah, they've been sort of all over the place, at least initially here in the after hours. We'll see where things settle out. I mean, there were folks on the street who cover this name, Julie, who were expecting good news in part because they were looking at the competition and what Uber had to say, and they thought maybe Uber and its business was kind of a read-through for DoorDash. But we also talked about, and I'll be very interested in how they talk about the consumer, because we've been kind of looking for those clues about where the consumer is at. DoorDash, its color and commentary will be really interesting on that front, too.
Yeah, in the release here, DoorDash is emphasizing that they have been investing, what they say is aggressively in the company to improve our offerings and launch new products and features that expanded our potential in local commerce. So they're sort of emphasizing that, and they say this year that will not change here, that they are going to continue to invest in those kinds of measures. So that's an interesting comment here in a time when we have seen, a pullback for many companies in those types of investments. So going to look for more details on that.
Yeah, I'm just looking at the statements in the release, Julie, and they're echoing that statement. The company talked about investing aggressively throughout the year to improve offerings. They talk about new products launch, new features to expand potential in local commerce. Talk about let's see, we are proud that our innovation investment helped generate nearly 50 billion sales for local merchants, over 15 billion in earnings from more than 7 million Dashers in 2023. Also, remember, we were talking this week too with a Lyft CEO, Lyft and Uber, some of these companies too, some of their contract workers expressing some concerns about pay and treatment. So we'll see if that comes up on the call as well. Yeah, one would think that it would. And one final thing to mention here, when I mentioned that gross order value forecast, the midpoint of it for the full year, $76 billion. The average analyst estimate, $76.5 billion. Maybe that's the area of disappointment here that's sending those shares lower. Yep. All right, well, coming up, a date has been set for former President Donald Trump's first criminal trial. We're going to discuss what kind of impacts it could have on the 2024 presidential election.
We've got Coinbase earnings coming out in just the past few moments. You're not seeing much reaction in the shares, and maybe that's because, man, this is confusing, if I may say so. Let's tell you what we do know right now from the company, which has just come out with its numbers. The company is saying, Coinbase is saying, it did have a surprise net income in the fourth quarter of $273 million. We're still trying to figure out how that comps per share earnings per share here. Fourth quarter adjusted EBITDA of $305 million and total revenue, it says, rising 41% to about $954 million. That number, that revenue number, we can safely say is ahead of estimates. The estimate for about $826 million. For the first quarter, Coinbase says it sees subscription and services revenue $410 to $480 million. Again, I don't have a comparable number for that, but trying to go through here and figure out, and it's confusing because analysts have been looking for a loss. It doesn't seem like we have a very clear per share comparable number for what analysts have been looking for.
Yeah, so far in the after hours, the stock isn't doing much. It's up about 0.5% about now, kind of bouncing around. Heading into this print though, Julie, the stock, it was off to a great start this year, but if you pulled back the chart, this stock was a monster over the past 12 months. And of course, a big reason for that was the approval that we've talked so much about those spot Bitcoin ETFs. And at least some investors were very excited about what that would mean for custody fees for this company, about what it would mean for just overall Bitcoin trading on the platform. Though there were also kind of skeptics, though. I mean, we talked to those folks, too, who said, what could it actually mean? If it's easier, it might be cheaper for some folks now to buy those shiny new spot Bitcoin vehicles than actually go to Bitcoin on the platform. So that'll come up on the call for sure, because I think the company's kind of pushed back on that and said, no, we think this is a net positive.
Well, because I think one of the unexpected things that has actually happened is we had a lot of folks who predicted a sell the news in underlying Bitcoin with the launch of the Bitcoin ETFs.
Yep.
And that happened initially a little, and then Bitcoin has gone up. So perhaps that's been something that has benefited Coinbase as well. Just one other thing I wanted to highlight from the release here. The company said this year it's going to focus on three main priorities. This is from the shareholder letter. First, driving revenue through improving core trading and USDC. That's the US digital coin. Secondly, driving utility in crypto with experiments in payments, which is interesting. And lastly, continuing to drive regulatory clarity in the industry. Brian Armstrong, the CEO, has been very vocal that the industry needs that clarity. Of course, this as the company is still under fire from the SEC for some of the products that had listed on the platform. Now, we're going to be talking much more about Coinbase and the crypto world more broadly in just a few minutes. We're going to be talking to Kathy Wood, ARK Invest CEO. Even though she recently lightened her holdings of Coinbase a little, she still has almost 5 million shares in her benchmark fund.
That's really great. I can't wait to hear what you have to say about the print. All right, a date, meanwhile, has been set for former President Donald Trump's first criminal trial. March 25th marks the start of jury selection in the hush money case, where he is accused of making payments to porn star Stormy Daniels to cover up a sex scandal during the 2016 presidential election. It's expected to last 6 weeks, and Trump claims it will impact his presidential campaign.
We want delays. Obviously, I'm running for election. How can you run for election if you're sitting in a courthouse in Manhattan all day long? I'm supposed to be in South Carolina right now, where other people are, and where, again, this is where I should be.
Rick Newman.
This is where he should be.
Aren't you guys looking forward to hearing a lot more about Stormy Daniels and Michael Cohen?
What year is it?
All right, so look, there's a turn of the screw seemingly every day in Trump's morass of legal problems, but this one's important because we're actually going to get to the start of a criminal trial. So there are 4 of these pending. This was the first one that anybody filed against him last year. It seemed like a big deal at the time because it was the first time this has ever happened to a former president. And then we had 3 more trials coming with a total of 91 criminal accusations. So there have been all these pleas along the way. Does he have to go through with this? Can he delay? And so on. So we finally have a trial that is scheduled, and it will be, assuming the schedule holds, it'll take about 6 weeks, according to the judge. It'll be finished by the time of the Republican nominating convention over the summer, and it should definitely be finished by Election Day. And this matters because there is a sliver of voters who say they support Trump, but they might change their mind if he is convicted of a crime. So he could, we now see a pathway to by which Trump could actually be convicted of a crime by Election Day.
There is another important case involving the former president, and that's in Georgia. It's an election interference case. But today, the fireworks don't have to do with the actual case.
Right.
It has to do with the prosecutors on the case who allegedly at issue is when they began a relationship. We know they had a relationship.
Yeah.
At issue is when it started.
And honestly, I think people hearing about this, they must just say everybody's screwed up. Because this was supposedly one of the strongest cases against Trump. This is at the county level, Fulton County in Georgia, and it's about his election interference when he said he needs somebody to find 10,000 plus votes. The evidence seems pretty strong, and then it turned out that Fani Willis, the district attorney there, the person she hired as her lead prosecutor is somebody she had been dating. So we're now. I mean, it's
Allegedly. Allegedly.
No, she said no. They have now both said they did have a relationship.
They did before.
Yeah. When did the relationship start?
Right.
She says, well, I don't know, because it's not like grade school when somebody officially asks you to be their boyfriend and you mark the date and I guess you cut yourself with blood and you make a little pact. She said it started sometime, like in 2022. And she says that relationship did end like last summer, which is before she hired him to be the prosecutor. But I mean, it just looks ridiculous.
Yeah. Right.
It looks ridiculous.
And basically, Trump's defense team would like her removed.
They would like the whole thing thrown out.
Right.
If they can't get that, they're trying to get her removed just to taint the whole procedure. So we'll see how this goes. But, is there any squeaky clean person out there? If somebody says I'm the one, don't believe them.
I'm not raising my hand. But
Rick Newman, thank you.
Hi, guys.
Appreciate it. Well, still to come, I'll speak to ARK Invest CEO Kathy Wood about the latest from Coinbase, the recent surge in Bitcoin, and much more. Stay tuned. More Yahoo Finance still to come.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi, down at the New York Stock Exchange, and a pretty big investor day for elevator, escalator giant Otis Worldwide. Let's get to Otis Chair and CEO Judy Marks. Judy, good to see you in person for a change.
Great to see you, Brian. It's great to be here.
So, we were talking off camera a little bit. This is a market obsessed with 7 tech stocks that, I don't know, investors, I think, are forgetting that there's other companies out there to invest in, companies like yours that are generating a lot of cash. Pardon the pun, give us the 15-second elevator pitch on Otis.
Oh, it's a great resilient service business. 2.3 billion people a day touch our product, and we service 2.3 million elevators. It lets us drive service revenues, and what we shared today in our medium-term guide, we're looking at $8 billion of cash generation between 24 and 28, which will return to our shareholders, and sustained growth EPS CAGR of double-digit.
Are investors still thinking of you as they must sell more elevators, and if they don't, maybe they don't make a quarter, but should they actually be thinking of you as maintaining all of these elevators and escalators and then building and service into this business and collecting fees from it?
Yeah, so our business model is simple and elegant. It's all about service, and we actually innovate and invent and manufacture elevators and install them so that we can get the service for 5, 10, 20, 100 years in some cases. This is all a service story. 60% of our revenue last year was service, $14.2 billion total revenue, top line. 90% of our profits were in service. Of our $2.3 billion, about $2 billion were service. We still make money on the new equipment, but it's all about the service and keeping the world moving.
The economy under President Biden is showing signs of improvement. Inflation is slowing. There are clear, I think, signs of improvement in the economy. It's getting panned. It's not getting noticed that I think to the extent a lot of people would expect. How do you see from your standpoint? A lot of money has been thrown into the industrial economy in here. Do you see it in your project flow?
So we still see healthy project flow. We came into the year with a new equipment backlog up 2% and a modernization backlog for refurbishment up almost 15%. And a lot of that's happening here in North America. We've got the backlog that gives us that line of sight for our 24 guide that lets us know what our revenue is going to be globally, not just here in the U.S. But in the U.S., infrastructure, it's going to be strong, just like it is everywhere else in the world, whether that's metros, airports, rail, and we've got a big play there.
Compare the U.S. to China. What does the China economic outlook look like? There has been concern about the slowdown over there.
So on the property side, the real estate side, absolutely. We were projecting this will be the 3rd year of a down market in China. And for our medium-term guide, we're saying China's going to be down for the medium term for the new equipment for building. On the service side, 8 million units are in service in China. It's a service play there, and we've doubled our service portfolio in the last 4 years. Grew at 20% last year alone.
And then in terms of Europe, I think that has been just a better story, right?
Yeah, Southern Europe's really still doing very well. Northern Europe, Germany, France, a little more challenged. But again, everyone needs mandated code-driven service, and that's where we excel.
Judy, you have quite the story. You've been in the industrial sector pretty much your whole career. I mean, tell investors a little bit about yourself, because it was only recently that your business got spun off of another business, 4 years ago?
Yeah, it feels like a lot longer with all the headwinds we had, but I couldn't be more proud of our team of 71,000 colleagues. I'm an engineer by background, but I've spent my entire career in industrials. And now to be able to lead such an iconic 170-year-old company into its future and to have the returns we have and to serve the customers, to have the customers we have that trust us and the passengers throughout the world that trust us, there's no better mission.
I think you've perhaps sold a lot of people that there's more stocks to invest in than 7 tech stocks. Judy Marks, always good to see you. Otis, Chair and CEO.
Thanks, Brian.
All right, guys, much more ahead on Yahoo Finance, including our team's interview with Kathy Wood. Do not miss it. We'll be right back.
Shares of Coinbase are on the move upwards after topping revenue estimates for the fourth quarter. Let's get reaction from someone who has a lot of skin in the game when it comes to Coinbase. Nearly 5 million shares in her flagship fund, to be exact. That fund is the ARK Innovation ETF, and Kathy Wood, ARK Invest CEO and CIO, is joining us right now. Hi, Kathy. Good to see you.
Hi, Julie. Great to see you. Thank you.
So let's first just dip into Coinbase a little bit here. It does look like the results beat estimates here. It looks like they turned a profit that was considerably larger than estimated. And there has been a lot of talk about the effect of the introduction of spot Bitcoin ETFs, the effect of the increase in Bitcoin prices. What do you think Coinbase is doing right now?
Well, one of the things that it's doing right is that it is, from a regulatory point of view, the most compliant exchange out there. And it's losing all its competition. Last year's demise of FTX was very important, and even Binance's issues have had a positive impact on Coinbase from a market share point of view. I think they're also in the right place at the right time, and they're executing brilliantly. The market is very volatile, so trading platforms benefit from volatility, and we certainly have had a lot of that recently. And then, of course, with the spot Bitcoin ETFs coming out, we've seen the price increase, or there's been volatility around it, but now it seems to be breaking out the price. And that's also good for Coinbase. So a lot of wins. And of course, their EBITDA was fantastic. They've turned into profitability.
Do you think that they will turn in a full year of profitability here in 2024?
Of course, a lot depends on what happens to the market, but I do think the signs are pointing up for that. So yes, Julie, at this time we do.
And I'm also curious, you said you find Coinbase to be the most compliant, in the crypto universe in this respect. Of course, the company is still fighting with the Securities and Exchange Commission over regulation of some of the securities it has listed. Do you think that the company is going to succeed in its battle with the SEC on that front?
We think the odds are high, and the reason we say that is because of Ripple's win, Grayscale's win, but especially Ripple's win, and what we learned about securities and timing of issuance versus trading on a platform when something starts as a security and evolves into something else, not a security.
I also wanted to ask you, I know that in your latest disclosure that you did lighten your Coinbase stake a little bit. I mean, it's still the largest position in your benchmark ETF, but I'm just curious what was behind that move.
Yes, well, Coinbase has had a magnificent move since all of the regulatory concerns were plaguing it last year. I think it's up more than fivefold. And so this is simple portfolio management. There are other stocks in the portfolio that are lagging. This has had a great move. And so it's simply trimming, profit taking, and really nothing more than that.
Let's widen it out a little bit to talk a little bit more about what's been going on in the crypto world. And you were recently out with your big ideas report for 2024, some of the big investable themes that you watch. One of them is Bitcoin allocation. And of course, you're now also in the spot Bitcoin ETF business with the introduction of your new spot Bitcoin ETF with 21 shares. But I want to zero in on that before we get to that. How are you thinking about Bitcoin allocation, how it will affect the underlying price of Bitcoin, and how sort of normal people should be thinking about how much to allocate to something like Bitcoin?
Yes. So if you look over the history of Bitcoin, the optimal allocation on average over this time period has been roughly 5%, maybe a little bit below 5%. That's the average. When we first put Bitcoin, or got exposure to Bitcoin through GBTC in 2015, the optimal allocation would have been less than 0.5%, but it's been rising. And I think one of the things that we learned in the last year that I think is encouraging asset allocators to think seriously about Bitcoin is it is not only a risk-on asset, but during the regional bank crisis last year, it appreciated as regional banks were falling apart. And so it has become a flight to quality asset as well. So think about that, risk on and risk off. Volatile to be sure, but risk on and risk off, that's quite something. And then the other thing to consider is institutions are, by and large, have not allocated to Bitcoin. And yet it is a new asset class. And they have to consider the ramifications of that from a diversification point of view. Diversification into a new asset class that is not highly correlated with other asset classes, stocks, bonds, commodities, and others, usually increases returns per unit of risk, which is what allocators want. And the other thing I'll note is the number of Bitcoin outstanding right now is a little over 19.5 million. The maximum number we will ever see is 21 million. So this scarce asset is getting scarcer, and institutions have not even gotten involved yet in any big way.
And you know, it's been interesting, the move that we have seen in Bitcoin after the introduction and approval and introduction of those spot Bitcoin ETFs like your own. Some folks we've talked to, including you, by the way, have said, well, maybe we would see a little bit of weakness just in the wake of that, and then it was a recovery. But the recovery has actually happened perhaps more quickly than people anticipated. Does that change the calculus for where Bitcoin might get by the end of this year, for example?
Yeah, as you know, we do 5-year plus forecasts, and so we're focused on how institutions and countries and companies might use this new asset class for different reasons, and so we think we've just begun from a price appreciation point of view. This is part of a journey. I do believe that the SEC giving the green light has encouraged institutions to think carefully about it and have a point of view. So we're in the learning phase right now, and I think over time that this movement into this new asset class will continue to push up the price. Whether it happens this year, you know, there are always short-term causes for volatility. So a 1-year period is pretty short, but over a 5-year period, our confidence is very high.
And let's talk about the comment in that spot Bitcoin ETF, the ARC21 shares product that I have alluded to a couple of times, has already reached a little over $1 billion in assets, about $1.3 billion in assets, I believe. The two largest products remain BlackRock and Fidelity's offerings. You know, how are you looking at the competitive landscape now that we're a little bit into it? And what are you targeting for the size of that product? Again, I mean, maybe you're looking at a 5-year projection, I don't know, but what are your hopes for that?
Well, it has been very successful, and we are very pleased to be number 3, if you're excluding GBTC, which has a much higher fee than any of us. Then you've got BlackRock, Fidelity, and ARC21 shares. That is fine company, and we are very pleased to be number 3. I think one of the reasons we are is our history with Bitcoin. We've been doing research on Bitcoin and publishing and giving it away since 2014. Another reason we think we're being successful is we have an incredible sales team at Resolute who has had to get its head around Bitcoin since 2016, when very few people thought it should have a place in a portfolio. They have developed confidence, they can explain it, and they can hold hands through volatility. And I think the other thing is our ops, our infrastructure and ops with our partner 21 Shares is showing itself to be very efficient, and you can tell that in terms of spread. Sometimes we'll have the tightest spreads in the market. So I think we're firing all cylinders, and I'm just so proud of everyone who's been involved on this journey with us.
Kathy, I want to switch gears. I guess we can't have a conversation these days without talking about Tesla, it feels like. So I got to ask you about Tesla. Do you think that the company should be, would you as a shareholder vote for Tesla switching its domicile from Delaware to Texas?
We're very supportive of that. What happened in Delaware, the judge ruling and basically taking the vote away from us, the shareholder. We voted for that pay package, 73% of shareholders did. And to have the judge kind of thinking that she is reading the minds of directors and independents, dependents, whatever. I just think, as I said in a post on X, I think it's un-American, it's anti-investor, and it's an insult to the board of directors of Tesla. So totally supportive of that move.
Are you supportive of Elon Musk's requests or demands or whatever you want to call it to get more voting shares? Or as he says, he'll take some of his technology elsewhere? Or do you feel as though Tesla's sort of being held hostage to that demand?
I do not feel that. Being involved in disruptive innovation and only disruptive innovation, we know that we need visionary leaders who will stand up to short-term oriented shareholders and be able to execute their vision with the right technologies at the right time. And Elon Musk is the inventor of our age, and he is also our Renaissance man. So I'm always surprised at the pushback he receives. And I do think that 25, he's not asking for any more economic interest, it's voting interest. And for many of our companies, we are supportive of super voting rights because we know the visionary leaders, we go through periods of volatility and they just need to be able to execute upon their vision, not be thrown off by boards of directors who are listening to short-term oriented shareholders and swayed by them.
Well, it's true that Tesla is going through a period of volatility right now. We got to leave it there, Kathy. We will catch up again soon. Thank you so much.
Thank you, Julie.
Roku shares falling after that company reported its fourth quarter earnings. The streaming service beat revenue estimates in the latest quarter, with active accounts surpassing 80 million. The revenue per user fell 4% from a year ago. By the way, this is another ARK Invest holding. Alexandra Canal is joining us now to break down those numbers. Hey, Allie.
Hey, Julie. Some pretty interesting moves here after hours, considering we did see that revenue beat, also double-digit gains in accounts and hours streamed. A negative, though, like you said, which could be driving the sell-off, is average revenue per user dipping 4% to $39.92. The company said that dip reflected, quote, an increasing share of active accounts in international markets where we are currently focused on growing scale and engagement. Along with that, we also received some bearish commentary in the press release, management warning of near-term challenges in the macro environment and an uneven ad market recovery. They said there's going to be difficult year-over-year growth comps and also continued challenges in media and entertainment ad revenue through the rest of the year. So that's the negative side. But on a few positive notes, revenue of $984.4 million, like I said, beating estimates, while an adjusted loss of 55 cents a share. That came in line with consensus. Full year 2023 active accounts coming in at 80 million. There was a net increase of 10 million from 2022, while streaming hours grew to 106 billion. That's actually the first time that the company has surpassed 100 billion streaming hours in a calendar year. And then if you take a quick look at guidance, they are forecasting break-even adjusted EBITDA in the current quarter, adding they expect to deliver positive adjusted EBITDA for full year 2024. But again, we're seeing the stock down 15% in after hours. So I'm curious to listen on that call and see what the analysts have to say there as well.
Yeah, most definitely. Accelerating to the downside. Allie, thank you so much. Appreciate it. Well, coming up, we'll take a look at the latest earnings report from DraftKings. Those shares also lower after hours, but only by about 1%. Stay tuned. We've got more Yahoo Finance coming your way.
Shares of DraftKings moving lower after hours. It's following a mixed fourth quarter earnings report. Let's bring in Yahoo Finance's very own Josh Schaefer for more. Joshua.
Yeah, Josh, let's take a look at the top line numbers here. Pretty good numbers from DraftKings overall. So revenue coming in at $1.23 billion, a slight miss from the Wall Street estimate of $1.24 billion. And then you take a look at that adjusted EPS number. You're seeing that coming in at 29 cents. That's above an estimate for 7 cents. That's a number that normally moves DraftKings stock pretty significantly, as this is a company that's been working toward consistent profitability as that space has been growing over the last couple of years. A couple other key things to note here, though, guys. Boosting their full year revenue guidance for 2024, now into a range of $4.65 billion to $4.9 billion. Before that range was $4.5 billion to $4.8 billion. But a big thing here that I think is sort of moving the stock and maybe giving investors a little bit of pause here, an acquisition. DraftKings buying Jackpocket.
And dropping a huge amount of money.
$750 million. And so as I was sort of saying, I mean, the story for DraftKings over the last year, the stock is up over 100%. The company's been doing a lot better, building market share in their online sports gambling space. And now they're trying to bring in more customers with this acquisition. But I think it will be interesting to hear what they say on the call tomorrow about just making an acquisition.
But what do you think? Greg, we have to wait for the call tomorrow, but sure. I mean, for sure, Schaefer, that was like the headline, $750 million for a lottery app. So what are they thinking there? What's the strategy? What are the synergies they see?
Yeah, I think they highlighted in their release, they want this to be a cross-selling opportunity, and you hear that a lot from the different casinos. When you think about some of the other players in sports gambling, right? You have, say, Caesars or MGM. Yeah. They can cross-sell from someone that goes to their casino into a sportsbook app. DraftKings can maybe do that in some ways, but when you buy a lottery company like this, it seems like their play is, now we're in the general lottery space. Someone can use this app on their phone and bet on the lottery on their phone. Then you bring them onto the actual sports gambling app, and you can sort of create potentially more revenue here. They did give an estimate for what they expect. They expect $260 million to $340 million of incremental revenue in the fiscal year 2026. So 2 years from now as they get into it, but they see that eventually growing revenue to some extent.
That's amazing. That's great. All right, it's going to be a good call tomorrow morning. Thank you, Joshua. We move on. Meta is firing on all cylinders. That stock is up nearly 40% just this year, boosted by earnings and a dividend announcement. But our next guest, who has been reporting on this company for 17 years, says despite its success, Meta is, quote, a tragedy of world historical proportions. Author and journalist David Kirkpatrick joins us for more. David, thank you for being here.
Thanks for having me, Josh.
So I thought it's interesting, David, because firing on all cylinders is a great way to put this, right? I mean, there's a lot of viewers who are watching right now, and they would look at this company and say, they seem to be just killing it financially, competitively. The stock's up 170% in the past 12 months. And normally, David, you see a move like that, analysts tend to back off a little bit. Not here. 85% of analysts still say you should buy this one. But your argument, David, is really that's only part of the story for Meta.
Thank you for saying that for me. Because, yes, your viewers love this company because it's made so many of them so much money. I mean, but and there's a weird dichotomy that exists here and that you have to really parse, because Zuckerberg is a brilliant business strategist, but he's also an amoral, antisocial human being in the way that he has led his company. Those things can both be true.
That's
Look, I mean,
tough words.
Haven't
What's
you
an
paid
example
attention
of
to all the news over the last, ever since Trump was elected, there have been an unremitting stream of reports, very well documented, many of them based on insider whistleblowers, about things they have known and chosen not to act on, about empowering autocrats, about harming teens, about privacy violations, of course, Cambridge Analytica. And they get a pass because they make people so much money. And look, they are in a brilliantly conceived business that is almost incapable of not making money. And I do think Zuckerberg has done a lot of very smart things from a cold-blooded business management point of view. Like, for example, pivoting away from the idiotic metaverse idea, which and we could talk about why they renamed the company, because I don't think it was quite what it seemed, to understanding AI really is the opportunity, and they have been investing in it for a long time, so they're incredibly well positioned, and they're already making money from AI with ad design, ad targeting, and so you can't fault them on figuring out good ways to make money. You can fault them on their social impact. Those are two different things.
Okay, so what do you do with that? In other, the history of corporate America is littered with companies that were very successful and amoral at best, evil at worst, right? And they just kept going, right? In some cases, they did it.
In some cases,
yes, that one, yes, is an example.
Lawsuits, etc.
But there are others that just kept on with the same business model or slapped in different ways, but kept on with the business model. So what happens, I guess, is what I'm asking.
I'd be curious to know what companies you think would be analogous to this one. Don't forget, they have 4 billion users. 4 billion. No company has ever had that. Maybe Google is in that range. But they have 4 billion users. They're about to surpass half of humanity. So their impact is so vast. They deserve our scrutiny in every direction. They are one of the world's most important socio-economic, socio-cultural forces in both realms.
And
so
yet
you cannot not pay attention to their impact.
And yet Congress time and time again has failed to regulate them.
True. Well, that's what
way.
the answer to your question before is, so what do we do about it?
Yeah.
We regulate. And Europe has figured that out. In Europe now, it's more or less about to be true that Facebook Meta will not be able to share data between Instagram and Facebook for ad targeting, which for them is very bad news. And they decided to do that based on privacy obsessions they have in Europe. I'm not saying that was the best thing to regulate, but the point is that is one of many, many regulatory innovations and initiatives that they've made in Europe that are beginning to push back against all these companies on perceived harms that Europeans care about. So they're showing that it can be done. In the US, don't forget, Meta is #1 in US lobbying expenditure of all companies. That is not a coincidence. They are very, very afraid of regulatory pushback.
All right, David.
I'll have to tell you about those other companies I think might be in that category offline.
Oh, I have so many more
really
negative things to say.
David, thank you for joining us. It was great. Appreciate it. Time now for What to Watch Friday, February 16th. Starting off on the earnings front, TC Energy, Vulcan Materials, Healthcare Realty, US Cellular, and Cinemark all reporting tomorrow. Cinemark still struggling to recover from the pandemic, but shares of the movie theater chain up about 17% to start the year, showing signs that the box office might be poised for a comeback in 2024.
Taking a look at the Fed, we're expecting another round of commentary from Federal Reserve officials. San Francisco Fed President Mary Daly and Fed Vice Chair for Supervision Michael Barr both speaking tomorrow. And this coming after hotter than expected inflation in January. And Barr saying yesterday that a path back to 2%, quote, may be a bumpy one.
And moving over to economic data, new numbers for housing starts and building permits from the Census Bureau out tomorrow. Housing starts ticking up and building permits down slightly. And we'll also get a reading on wholesale inflation, the producer price index coming out after the hot CPI reading earlier this week. Julie, tomorrow,
that consumer confidence report is going to be really interesting, right? Because last month's report was another piece of evidence that the consumer is doing just fine, thank you. And so I think it especially gains more importance after today's retail sales report that came in worse than estimated. Will we see sentiment hold up even as we saw that figure go down? And is it further going to muddy the picture for the Fed? Probably, but it'll be an interesting number to watch.
All right, I'm just going to watch this market and see how we end up here. The S&P 500, the SPX has been up 14 out of 15 weeks. So can we go 15 out of 16? We're actually kind of just fluctuating right around those levels. So we'll see how we end tomorrow.
We will.
We'll both be here.
Suspense. We'll be here tomorrow. And that does it for us today on Yahoo Finance Live. Come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.